Today we discuss 4 key charts, and make sure you subscribe to the channel so that you don't miss anything. Number 1 chart is Bitcoin in profit. We see the date on the x-axis, the price of Bitcoin on the y-axis as usual, and then on the color overlay the percentage of Bitcoin in profit. And it can be 100% in the bull markets and at the top of the bull markets especially, and it can be as low as 60% or actually 50% in the bear markets. And I made the cutoff point at 60% because it shows better the patterns that are in those signals. Now we're looking at the on-chain Bitcoins. It's all the 19.3 on-chain Bitcoins, no paper Bitcoins, so no Bitcoins on exchanges, which are basically IOUs, and no Bitcoins in derivative instruments like futures and options, only on-chain real Bitcoin. Now, what we see, and it's very important, is that the percentage of Bitcoin in profit flipped from 50% to 72%. It already did that in January, but February continues that signal. And yeah, we can look up in earlier periods like 2011, it did the same thing. It flipped from blue to green, from like 50-60% to 70-80% profit. Same in 2015, 2019. So this is a very important signal, and what it basically means is that all the buyers from 2021 at 40, 50, 60K, they're basically gone, and they have sold to buyers below 20K. And that's a lot of Bitcoin. That's actually 5.5 million Bitcoins that changed hands from a losing position to new buyers in a fresh position. And those new buyers, those 5.5 million Bitcoins, are now in profit. And I remember very well when I made my first Bitcoin investment and made my first profit, even if it's only 10 or 20%, which is an easy 10 or 20%, which cannot be easily made in other assets. When I made those profits, I thought, well, that was nice. I want to do that again with some more money. So this is a very interesting phenomena, and it's also irreversible, by the way, because those people are gone. Those are the new ones, and it will not go back to this position. So it's very one-way street. What we're waiting for is 85% yellow, because that means that even the few buyers in 2021 at 55, 50 and 60 and even 69K, that those buyers are gone as well. It's clear skies from there, and when we see yellow, the FOMO will probably kick in. Very important chart. Next chart, the S&P 500. And we talked about this chart before, but we'll do it again, because it seems that the main bear argument is macro uncertainty with inflation and recession and the war. So the S&P is basically a proxy for macro, because stock investors, they'll price in all the expectations and all the information out there on inflation, recession, what the central banks are doing, what the potential war is going to be. So all that is priced in by the stock market, and stock market is big, so it's a nice proxy, and it's always good to know that everything out there, all the macro information, is already priced in the stock market. That's your assumption. And it's called the efficient market hypothesis, by the way. So it's always a good assumption, and I'll for sure make that assumption. Now, stocks bottomed here in October already, and Bitcoin bottomed a little later in November. So there's a little lag. It seems that the stock market is leading the Bitcoin market, which would be logical because the stock market is, well, I think about 20 times, or maybe more, about 200 times bigger than Bitcoin. So, and we see in earlier days that same lagging period. So in 2011, there was a dip in the stock market, and then a bottom, and a later bottom in Bitcoin. Same in 2018. There was a bottom already here in the stock market, and later in the Bitcoin market. So there is this lag, and in my opinion, the Bitcoin has some catching up to do with the general stock market, and the implied Bitcoin price from that stock market is about 55K. Next chart, stock to flow model. Very interesting chart right now because, well, as you know, stock to flow measures scarcity. It's about the 21 million Bitcoin cap. There cannot and never be more than 21 million Bitcoins. Not even one Bitcoin for every millionaire in the world. It's really scarce. And this model uses that stock to flow ratio, of course, to model the Bitcoin value. And well, one important thing to notice is that value is different from price. So the gray line is the model value, and the color dots are the Bitcoin price, and price is different from value. It can be below the value line, like now. It can be above the value line in the bull markets, and well, that's in fact what the error is pointing out. So the error, is the Bitcoin price divided by the stock to flow model. So right now the Bitcoin price is about 20, and the Bitcoin stock to flow model value is about 60. So 20 divided by 60 is 0.3, and that's what this value is. And for example, if we go to the all-time high in 2013, the price was 1,000, and the Bitcoin value, or stock to flow model value, was about 100. So that's a 10x above the model value. So it can be below, it can be above. That's not a problem. Now, there's a lot of critics, a lot of critique on this model, and one of the main things is about the autocorrelation or serial correlation in the error. Now we see the error right here, and we see the autocorrelation as well. So if the Bitcoin is below the model value, the chances that the next dot is also below the model value is very high. It's not like the error value is random noise, and you don't know what the next dot will be, where it will be. There is some serial correlation. This dot depends on that dot, depends on that dot, etc. Now, that means the model is misspecified. It gets worse when you do, because it's a monthly model, when you do daily models, because you introduce more serial correlation, because the main signal, of course, in this stock to flow model is the halving, and there's only 3 of them, and in between the halvings not much happens on stock to flow, and of course a lot happens with the price. So there's several reasons there can be serial correlation, and this misspecification of the model can be easily fixed. And one of the reasons is that the sampling is wrong. So we can go, and that's what I did at the time, to less sampling, for example, yearly sampling, and that will fix not all, but most of the serial correlation problem. Another issue is that could be that we're just missing variables, and that of course is very true. I mean, stock to flow is certainly not the only variable that explains the Bitcoin price. There's macroeconomy, there is interest rates, there's demand. That's not in the model. This is a pure supply side model. So there's all sorts of variables missing, and that can cause this serial correlation as well. Now, the other critic is co-integration. If we are looking at, especially on a log scale, at a line that's going up, something that's increasing in value, then, well, everything that's going up so the world population, for example, everything that's going up will explain some of the correlation, or will have a correlation with that increasing price value. And but it not necessarily is a causation. It's correlation, not causation. So it might be a spurious correlation, and you know that can very well be. And co-integration then reduces the chance of it being a spurious correlation, and it looks at if the two series, so in this case the stock to flow model value and the price, Bitcoin price, if they stick together. So it can be above, but then it goes below, it can be above, then it goes below. And there's a measure for that. There's all sorts of co-integration tests that you can do. But it assumes two random variables. Now, the Bitcoin price is random. That there's no doubt about that. But the stock to flow value is not really random. We don't know exactly what it will be. There are some small hiccups, of course, in the number of blocks that are mined every 10 minutes or every day. But, in general, we know the stock to flow for the future, and that makes it, by the way, a perfect candidate for prediction, of course. But it also means we cannot apply the co-integration tests. So, although the series stick together, we cannot apply the tests, and, we conservatively have to assume that the correlation is spurious. One last critic was, and that's I think the most important one, is the efficient market hypothesis that we talked about before. I wrote an entire article about it, by the way, stock to flow, Bitcoin, and the efficient market hypothesis. And there's more articles from other people. But basically, the efficient market hypothesis says you cannot predict anything. Stocks, interest rates, Bitcoin, all the information out there is already priced in the market. It's in the price, and prices are completely random. And that is the best argument you can make. And there's, different counter arguments you can make. I mean, Bitcoin is a very new asset. Not many people know the basics, especially when you hear some economics professors, even Nobel Prize winners, and very large hedge fund managers, famous investors talk about Bitcoin. You'll notice that they don't know anything about it. They just misunderstand it. And that in that misunderstanding is value, is opportunity for people who do understand Bitcoin. And especially since there is no valuation model for Bitcoin available, like there is for stocks, like dividend, cash flow, discounting, etc. There's nothing for Bitcoin. This is the first attempt, or maybe the second attempt. We'll get to that later. But yeah, so there could be some deviation from the efficient market in that the information is not readily available or understood by everybody. Anyway, in the end, it all boils down, all the critique, to one point, and that's, is this correlation between the price of Bitcoin and the stock to flow ratio, is that a spurious and nonsense correlation or not? I don't think it is. I think the scarcity argument is a very first principle based argument that investors know very well. I mean, scarce goods, scarce things are more valuable than non-scarce and abundant things. For example, houses, beach property, houses in good locations. The scarcer they are, the more valuable they are. So it's not a weird thing to think. So I think the stock to flow model is still valid. And well, I mean, it was made here in March 2019, and it basically predicted that the price of Bitcoin would go up after the next halving, after the 2020 halving. And that happened. So it might not have gone all the way up to the average of 55K in the first article, or 100K on the later yearly model. But it's not that nothing happened, right? There were a lot of people, in fact, many people at that time, talking about the halving as a bad thing, as something that would cause a minor death spiral and a Bitcoin price that would be much lower. So this model helped me at least to know that the halving and the scarcity increase that's associated with that halving is a good thing and would increase the price of Bitcoin. And I think that will happen again in the 2024 or after the 2024 halving. So very interesting. And mind you, another thing, we still have 1 year to go in this cycle. So it's very well possible, or at least not impossible, that we'll have a triple top cycle this time. So every cycle saw one big bull market, one big all-time high. Right now we saw two double tops, all-time high. But we could, theoretically, in this cycle, still go above the stock-to-flow model and above the 69K all-time high, and that would make it a triple top cycle. So not ruling that out, time will tell. Very interesting time ahead. Next chart. Well, the stock-to-flow model is sort of it was a valuation model, it's a fundamental model, but there's more models. And one of the first models is actually the time model. And the time model is the light blue line. Is the first one I know is the 2014 model of 𝐓𝐡𝐢𝐬. And that's pretty accurate model. It's sort of adoption based, like adoption of Bitcoin will come with time, and so the increase in price with time will go with that. And the first models were like logarithmic regressions. I made a power law variant of that, and this is the formula. If you take the year, for example, this is the first year, so you put a 1 here, and you do that to the power of 6, and then times 0.003, then you get this value, and the same for the second year, third year, etc., etc. And it gives this very nice smooth line that you also can extend into the future, which makes it a perfect prediction model. Now, the stock-to-flow, we talked about this. It's also a power law model. In fact, all the models that are shown in this chart are power law models. The famous formula is 0.4 times the stock-to-flow ratio, which is 57 right now, to the power 3. And that gives the dark blue line. You'll notice that the dark blue line gives roughly the same estimates as the time model, but it adds one thing. It adds the importance of the halving as a cause of the price increase. So it points out that the price increase of Bitcoin is always around the halving, after the halving, and so in that sense it adds something to the time model. Then there is the 𝐓𝐡𝐢𝐬 model. 𝐓𝐡𝐢𝐬 model is, based on transactions. Every transaction splits a current Bitcoin or an unspent transaction output into 2 or more unspent transaction outputs. So it's the transaction will have the amount that you'll want to send. It will have a cash rest amount, so the amount that is sent to your own wallet again, and it will have a fee for the miner. So usually it's sent to more than one UTXO. So every transaction increases the number of UTXOs, and that makes it also like the time model, an adoption proxy. It's the green line. And then the last model is difficulty. Difficulty is based on the hash rate of Bitcoin, which is set every approximately 2 weeks. And that difficulty, of course, is the security of the network. And security of the network is, if that increases the value of the network as well. And the higher the hash rate, the more miners there are, or the better hardware there is. So for example, here we see a big jump in difficulty and thus in model value, because the miners changed from CPUs to GPUs to graphic cards. And then later in 2013, they switched to ASICs. and that's application specific integrated circuits. So computers that can do only one thing, and that's Bitcoin mining. And now from there, once we had ASICs, it grew very, very slowly to where we are now. But in fact, the difficulty model is now spot on and much better in predicting the Bitcoin price at the moment, mind you, at the moment, than the time model and the stock to flow model. So what the future will bring, I don't know. I do expect the Bitcoin price to go to make a reversal back to the stock to flow and the time model levels. But we can also see the hash rate going up, increasing dramatically. I wouldn't be surprised at all if that happens. So we'll track those. For sure, the models have stayed close together, especially in 2011, 2013, and 2017. Coincidentally, also the all-time highs of the bull market at those times. But the models can also be very much apart from each other, like 2012 and 15 and right now. So, well, that makes it very exciting what the future will bring. Again, I think the Bitcoin price will reverse back to the stock to flow and time model values of around 100,000, or even after the halving, more than 100,000, between 100,000 and a million. Well, that was it for now. Thanks for listening. Please subscribe to the channel so you miss nothing, and see you next time.